Hello everyone. Our group members are Ma Ling, Zheng Yiran, Cui Jing, Wang Shuzheng, and me. Our study examines the impact of US dollar appreciation on ASEAN exchange rates and inflation from 2019 to 2024. Okay, now let me first. Since 2019, the US dollar has strengthened, especially after the Federal Reserve raised interest rates in 2022. This encouraged global investors to move capital into US assistance, leading to capital outflows from many Asian economies. As a result, several Asian countries, including those of Malaysia, Indonesia, Thailand, and the Philippines, depressed while the Singapore dollar remained relatively stable. These recent depressions increased the inflationary pressure in the region. When local currencies weaken, the cost of important goods rises. Because many Asian economies depend heavily on imported food, energy, and intermediate goods, higher import costs are passed on the domestic prices. This process is known as exchange rate pass-through. To manage these prices, Asian policymakers respond with measures such as interest rate adjustments, foreign exchange investments, and targeted financial policies. Based on this context, our study has three objectives. First, we examine how US dollar operations affect the Asian exchange rates. Second, we analyze the link between currency depreciations and inflation. Third, we compare policy response across Malaysia, Indonesia, Thailand, the Philippines, and Singapore. Overall, this study highlights how global monetary changes affect exchange rates, inflation, and policy decisions in Asian economies. I will now hand over to my group members for a more detailed discussion. Okay, next part.
Okay, now I will talk about the literature review and research. Many studies show that when the US dollar becomes stronger, many emergency market currencies become weaker. Capital often flow out, financial conditions become tighter. This result is found in many studies, such as the of 20,000. Asian countries are very sensitive to US dollars movements. These countries are very open to trade. Many transactions are in US dollars. When the dollar rises, currencies like the ringgit will fail, and this makes imports more expensive and raises inflation. The period from 2019 to 2024 is very special. The world faced COVID-19, supply chain problems, and high energy prices. After 2022, the US dollars raised interest rates many times. Because of this, the US dollar became much stronger. Asian countries faced higher risks, weaker currencies, and higher inflation. However, studies on this period are still limited. There are three main research gaps. First, many studies focus on year before 2019. Few studies look at 2019 to 2024. Second, many papers study exchange rates or inflation but not both together. And the final is Asia is often grouped with other emerging markets and not studied on its own. Therefore, the study used new data from 2019 to 2024. It examines how US dollar appreciates, affects exchange rates and inflation in Asian countries. This study adds new evidence to the new literature and research. Okay, next person.
Okay, for the next part, methodology, I use annual ASEAN 5 data from 2019 to 2024, including Malaysia, Indonesia, Thailand, the Philippines, and Singapore. I chose this period because it captured both the COVID-19 shock and the post-pandemic tightening, which clearly affected exchange rate and the inflation across the region. The data come mainly from IMF, IFS, and World Bank WDI, and I cross-check with ASEAN status and central bank sources for consistency. The key variable are the official exchange rate (LCU) per USD, the depreciation rate, which is the percent change in exchange rate, the CPI inflation, annual percent. Optionally, I include trade balance as an external buffer indicator. Method-wise, the study is descriptive, so there is no complex regression. First, I use trend chart to compare depreciation and inflation over time for each country. Second, I use scatter plots to visually test the exchange rate pass-through to inflation. Finally, I report basic descriptive statistics and a simple correlation to summarize the direction and strength of the relationships. Overall, the aim is not to prove causality, but to compare patterns across Asian 5 and identify where currency depreciation is more strongly associated with inflation. Next person, please.
In this part, I will example analysis and the result of our study. This study looks at how a strong US dollars affected exchange rate and inflation in four Asian countries: Malaysia, India, Thailand, and Singapore from 2019 to 2024. We use the data such as exchange rates, the US dollar index, and the inflation rates to understand this change. First, let us look at the region background from 2019 to 2024. The US dollars become stronger especially in 2022. This happened because the United States increased its interest rates. Higher interest rates made investors move their money to US. As a result, the US dollars become stronger. At the same time, money flowed out of some Asian countries, and their craze become weaker. Now, let us look at each country. In Malaysia, the ringgit become weaker, but not by much. The government proved subsidy and managed the economy well. Because of this import price did not rise too much and inflation stayed low. In Indonesia, the central bank issued interest rates to support the high. Those actions helped keep the currency stable and prevent big change in price. In Thailand, the impact was stronger. In 2022, the Thai banks fell quickly and inflation increased a lot. Higher interest price and weaker central caused price to rise faster. This shows that Thailand was more affected by external economic shock. In conclusion, all four countries were affected by the strong US dollars, but they result were different. This is because each country used different economic policies. Overall, the result suitable international economic through a strong US dollar, African Asian countries, but government action decide how serious the impact is. Next person.
At last, I will do a conclusion. While the strong US dollar exerted pressure on all Asian 5 countries economics, the outcomes varied significantly. The Malaysia ringgit, Thai baht, and the Philippine peso depreciated notably, reflecting their high sensitivity to global capital flow and interest rate. In contrast, the Singapore dollars remained stable. Singapore's MAS employs a unique exchange rate centered policy framework instead of relying on interest rate. This approach provides a more decorative buffer for a small, open economic, highlighting the practical importance of the monetary policy anchor. Currency depreciation gently correlated with rising CPI, but inflation drivers differed. In Thailand, inflation was driven large by reliance on important energy and resurgent tourism damage. In Philippines, beyond currency efforts, domestic supplies issue food price raise. Exchange rate movements acted as a man flying glasses. Most central banks raised the interest rate to stabilize the currency and club inflation with varying cost. Bank Indonesia used a pragmatic mix of rate hikers. Other faced a third trade offer between supporting growth and controlling inflation. By 2024, inflation had rested in Malaysia and Thailand, indexing the eventual effectiveness through pinfall of tightening policies. The strong USD shock tested economic realities and exposed Singapore's policy frameworks provide robust, while others face great challenges. Okay, that's all.
Okay, this is the end of our presentation, and thank you for listening.